Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. An hour to go until the closing bell. You're still looking at a mixed picture with the Dow up just 65 points, trying to snap the 5-day losing streak. S&P and Nasdaq, though, trading to the downside. Now today's moves coming as investors still assess the latest developments out of Russia, the revolt inside the country over the weekend. Right now, it's not having much of an impact on the equity markets, but a lot of the focus has been on commodities and what a revolt inside Russia, what that could potentially do to disrupt supplies going forward. We did see a brief move higher in the price of wheat, also in the price of crude, although both of those are pulling back from those highs that Kiko with crude still below $70 a barrel.
Yeah, Shauna, we are beginning this hour with those latest developments you just alluded to in this ongoing war between Russia and Ukraine. The head of the mercenary group that led a rebellion against Vladimir Putin over the weekend, breaking his silence, saying he was not attempting to oust the Russian president, but simply demonstrating his protest over the Russian military. Now, the actions led by Yevgeny Prigozhin, raising questions on Putin's control and the stability of one of the world's largest producers of oil now. Here to discuss the rippling ramifications of it all, we've got Michael Hanlon, Brookings Senior Fellow and Director of Research in Foreign Policy. Michael, great to talk to you today. Give me your assessment on the effect you think this rebellion or not rebellion will have on the ongoing war effort.
Greetings. I think the effect will likely be modest, but we can't really be sure. I think in the short term, it looks like Putin has prevailed, even though Prigozhin is, as you say, pushing back a little and now trying to, defend himself a little bit more fully, maybe make this seem like less of an out-and-out showdown with Putin, and maybe even establish a little bit of a base in Belarus. But the fact that he's talking about that latter idea for the Wagner Group underscores that he really has to retreat here because, of course, Belarus is essentially a Russian puppet. So you're not going to get any kind of protection or sanctuary just because you're operating there, either at his individual level or in terms of the Wagner Group. And as you know, Russia's been trying to bring the Wagner Group back into the fold, so to speak, in recent months. I think that effort will continue, maybe even more so. And at the same time, I think that we probably won't see a dramatic effect on Russian fighting positions inside of Ukraine because chances are that Putin is going to go slow here and not sort of dismantle the Wagner Group too quickly. So he's going to try to make sure the Wagner people on whom he depends for some of that fraction of the front line still feel like they are better off fighting for Russia than fleeing or fighting against Russia. And my guess is if they're being asked to defend trench lines, they will have enough morale to do that, even in light of what's happened. So my best guess is no dramatic change within Russia itself or on the Ukrainian battlefield. But of course, we'll have to see. And things could change over a period of months, partly as a result of this.
Michael, what message, though, do you think this sends to the rest of the world, not only inside Russia, but more specifically what it means for China, which we know clearly has close ties with Russia?
I think China is just going to keep hedging and, doing what's best for China in this regard. They don't send weapons to Russia, as best we can tell. I don't think they'll change that policy. They give Putin a certain amount of rhetorical support in the sense of blaming NATO expansion for this conflict, but they don't go so far as to, actually help him in any material way, besides just buying stuff they want to buy from Russia anyway. And frankly, buying stuff that we want them to buy from Russia, because as you know, we've been part of this oil cap concept, which actually is a way to keep Russian oil and gas on the global market, even if we in the West choose not to want to buy it ourselves. So China's going to stay in this middle zone. They're pro-Putin at some level, but they're not going to go so far as to become an active participant or to send him any appreciable amount of weaponry. And I don't think they're going to change their view. They'll be a little more nervous, but they'll also recognize that he's probably survived this challenge from the number one potential rival he had in the entire country. And therefore, it's hard to see somebody else rivaling Putin, challenging Putin, mounting a mutiny or a coup attempt anytime soon. At least that's my best assessment, and that's what I believe the Chinese will conclude as well.
So, Michael, it doesn't sound like you think there's a dramatic shift in the war, but you did have the likes of Secretary of State Antony Blinken, at least over the weekend, sort of pointing to how this could signal some Russian fragility here. And I wonder, from a policy standpoint, how do you think this shifts the discussion for the U.S. and NATO allies?
Well, it only shifts it a little. I mean, Secretary Blinken's, I certainly think, correct but the weakening may be modest and Putin won't want to acknowledge it. And therefore, it will play out over a period of weeks and months, not hours and days. And so what I think you could imagine, let's say we get to the fall and the Ukrainians have taken back some of their territory. My guess is they won't get back more than, I don't know, a quarter of it, the 17% of their country that Russia still occupies. And then Putin's got a decision, and so does Zelensky, and so do all of us. Are we going to sort of help get ready for another round of similar fighting in 2024 with no end in sight to this conflict? Or are we going to sort of think of ways to compromise? And at that point, in the fall, I'm suggesting, Putin may say, I've got internal problems. The economy's not in good shape. The Wagner Group remnants are still, upset about what happened. Maybe I'm better off not fighting this war for 3 or 4 more years. Maybe I'm better off looking like the peacemaker, trying to wind it down. I could imagine that kind of calculus shifting a little bit, at least partially, as a result of what's just happened. But again, I think it'll take months, and this is just speculation. It's also possible that by the fall, Putin will have completely stamped this whole incident down and out of our memories, or at least out of active, policymaking, and he won't be affected in the least.
Mike, what about the image that Russia is still trying to portray? At least up until this point, they seem to be trying to send this message that it's business as usual. You mentioned the fact that you don't see this having any real material impact, at least for right now, in Russia's advancement in Ukraine. At what point, when you're talking about the fact that maybe this conversation could change by the fall, what would be the trigger of that?
I think that, Putin will internalize the extent to which he's seen a serious domestic uprising against him. Now, he managed to rein it in, and now the guy who instigated it is saying it wasn't really against Putin anyway. And I don't know that there's anybody else who could do this besides Prigozhin. Still, Putin's got to recognize there's some unhappiness here. There's some unhappiness in the sense the Wagner Group's been more popular than his own military. They're a year and a half into a war they're not winning, even if they're also not really losing at the moment. He has to think hard about, does he want World War I? Does he want 4 more years of carnage with uncertain prospects? Or does he want to say, whatever fraction of Russia or of Ukraine he still holds by the fall, let's see if he can solidify his control of that in some kind of an armistice and get back to some quasi-normalcy. It won't be like it was before, but, maybe he could end the fighting and end the economic decline of his own country. That's possible. But this would just be one of the factors that would go into that thinking, and maybe not even the most important.
Yeah, I mean, that sounds like a better case scenario. I wouldn't say the best case scenario, but from a market's perspective, clearly investors watching the commodities market to see, how in fact Vladimir Putin could potentially weaponize the energy markets. I mean, that's been dangled before. Is there any likelihood, because of what played out now, of that risk increasing?
Well, yeah, I think that I just get nervous about any kind of big war in the middle of Europe going on indefinitely, because I see no reason to just assume that things will be, extrapolated out and sort of follow the same trajectory they've been on. So the fact that the war is sort of stalemated, that energy and grain markets are sort of semi-stable, that we haven't heard a lot of nuclear threats in the last few months, I don't take any of that for granted as a prediction of what may ensue this summer or fall. And at some point, somebody could have a big incentive to try to really destabilize or disrupt the whole situation. So I'm, a pretty big proponent of trying to find a way to wind down the violence relatively soon, even if Ukraine doesn't get everything back that it wants, and maybe, play the longer game diplomatically to try to get back the full extent of its territory rather than think it can do so on the battlefield. There's no reason. Wars don't tend to go in straight lines. If you look at a certain period of a few months, whether historically or in real time, it might seem like you have a period of a few months where you have more or less a steady state. But then there usually is some kind of a divergence off of that. And it's an inherently unpredictable business that we're in right now.
It certainly is. Michael, it's good to get your perspective today. Michael Hanlon, Brookings Senior Fellow and Director of Research in Foreign Policy.
Thanks.
We are just getting started here on Yahoo Finance Live. Coming up, Carnival stock hitting some rough waters today despite an earnings beat and better than expected guidance. We're going to dive into what's causing the sell-off, and we'll hear from the company CEO in the 4 p.m. hour. Plus, The U.S. IPO market is picking up following Kava's strong debut. We dive into the next initial public offerings that are on deck. And TikTok is dominating the mobile landscape as it becomes the first app to surpass $1 billion in consumer spend in a single quarter. More on what's next for the social media giant when Yahoo Finance returns.
Get the modern survival skills, which, as you and me know, modern survival skills, being literate digitally, is a modern survival skill. Always being adapting, because I think the media world, the technology world changes so fast. If you're slow to adapt, you get run over. Sometimes life sucks. Sometimes survival sucks. Things are hard. Get used to it. Keep going forward. Keep a smile on your face. Win the long game. Lose a few battles along the way.
Investors largely shrugging off a failed revolt inside Russia that is leading to questions about Putin's grip on power. Stocks are mixed with an hour to go until the closing bell, with the Dow barely holding on to gains. We want to bring in Cameron Dawson, New Edge Advisors Chief Investment Officer. Cameron, it's good to see you again. So let's start with the latest developments out of Russia, how investors are looking at that. We did see some reaction in some commodities. Crude didn't move on the news, as well as wheat. But more broadly speaking, when you take a look at the equity market, we haven't seen a heck of a lot of reaction. Why is the market, at least for now, looking at this as a non-event?
Yeah, I think you had it exactly correct, which is that it is just a shrug. And I think that the risk would have been if this event would have caused Russia to be unable to continue to flood the markets with heavily discounted oil. This has been one of the reasons why we have seen weaker oil prices, which really has helped and benefited the inflation story in the US, meaning that we have seen it filter in through lower goods prices. And so if we were to be in a scenario where Russia's ability to continue to pump oil into global markets was disrupted, and that would have caused an inflationary episode, that really would have been the key risk-off signal. But because this was resolved for now, it doesn't seem to be an event that the market is taking as a key negative yet.
Cameron, in many ways, this points to just how much more the concerns are in the market about the slowdown in the broader economy. The fact that this event that was significant within the Russia-Ukraine war wasn't necessarily the driving factor in the oil prices, at least in the trade that we saw today. We're looking at prices that are still below that $80 level that OPEC would like it to be. To what extent does that put pressure on the cartel in terms of this next meeting? And are we likely to see further pressure to the upside?
Well, it's really interesting that all of these supply cuts that have come out from OPEC Plus really have been falling on deaf ears from an oil market perspective, meaning that oil prices have continued to slide since they started cutting production, which really speaks to that we're still living in a world where demand concerns seem to be the bigger issue. And it's really demand all around the world, fears that maybe the US economy could stumble. Those have not been verified by data yet, meaning the US economy still remains rather robust. But then, of course, we had increased fear coming out of Europe last week with those weak PMIs. And then it's China. And China really has been disappointing as far as an oil demand has been from their reopening. And there is concern that that reopening, even as lackluster as it has been, is continuing to flag, which just means that the overall demand picture remains uncertain, which is why we continue to see these oil prices struggling to get above the $80 level.
Cameron, one of the key things, obviously, that investors are watching here in the U.S. is what's going to come from the Fed next. Lots of questions just about what policy is going to look like going forward, whether or not another rate hike should be and will be likely here going forward, and more specifically at the next meeting in July. What do you think is necessary at this point, given the fact we're still so far from the 2% inflation target?
Yeah, exactly. We still think that this is a Fed that's in inflation fighting mode. And we do think that they will hike in July, that the data continues to support that. The bond market agrees. There's now about a 71% chance that the Fed does hike in July, which just means that inflation remains far too sticky and far too elevated on a core basis for their liking. We're not close to that 2% level. And things like wages are not consistent of getting down to 2%. Atlanta Fed wage tracker is still running at about 6%. It's starting to roll over, but that is not consistent with a rapid return to the pre-pandemic level of inflation. So when you put it all in together, it means that the Fed is likely still to lean hawkish from here with one more hike in July, and September is still a very live meeting. And of course, we'll be listening to the Fed's comments in August at Jackson Hole to really see how they're looking at this balance between inflation, which is moderating, but still a very tight labor market, which could just keep them in this higher for longer camp.
So Cameron, you're in the camp that you think the Fed's actually going to raise come July. To what extent does that shift your expectations or your outlook for the market?
Well, the Fed really hasn't mattered for the market this year. And this is one of the things that has surprised us the most, is that we expected the economy to remain more resilient, inflation to remain hotter, which would keep the Fed tighter, and that to keep a downward pressure and kind of a lid on where valuations could go within equity markets. But equity markets haven't cared at all. We've seen huge valuation expansion in equities and mostly in growth stocks, which have typically been those that are most sensitive to the path of Fed policy. So it's a good question. If the Fed continues to ratchet up its hawkishness, will equities eventually listen? We've seen a big divergence between interest rates and growth valuations. And it's a good question of, is that sustainable if the Fed doesn't deliver on the hoped for easing that the bond market has been so eagerly pricing in really all year long?
Is it sustainable, do you think?
I think that eventually gravity applies. Eventually yields will matter. The problem or the challenge is that valuations are really a terrible timing tool, meaning that if you look at the correlation of valuations and forward returns, there really isn't much predictive power. You really have to look out past 2-3 years to get a sense of if high valuations are today, that it correlates to lower forward returns. So for us as long-term investors, what we see is a world where valuations are very high, and that likely requires us to lower our expectations for returns really over the next 2 to 3 years. But that doesn't mean that markets can't continue in the short run. Valuations can go high and stay high. Markets can have great momentum. And so as we continue to see markets with momentum press higher, valuations diverge from yields, that's where the risk reward begins to look less and less attractive.
So am I hearing that you're still in the risk trade, or you're taking risk off the table now in anticipation of some of the choppiness?
So one of the things for us as long-term investors is that we do remain fully invested, and we have had a higher weighting to cash over the last couple of months and really the last year, but a lot of that's coming from the fixed income side, meaning that we are neutral equities. What we've been doing is staying in the high quality part of the equity market, meaning that we haven't been chasing low quality. We haven't been chasing the beta and the speculative trade, which has led us to lag in certain rallies that have really led this market in those parts of the market this year. But as we look over the long run, we think it's very important for us to have that steady exposure to quality, mostly if we go into a period of weaker economic growth. And so overall, we remain invested, but we express some of our valuation discipline by focusing on cheaper parts of the market and those quality factors.
Cameron, what are some of those cheaper parts of the market? More specifically, when we're diving down into sectors, which do you prefer at this point, given the fact that there's so much uncertainty?
Yeah, it's one of the things that really is interesting is that if we're looking for new capital, we prefer and we're looking at an index portion of capital, meaning we want to index something. We'll favor the equal weight index instead of the value index, because value is so very overweight to financials, and financials continue to have really weak trends within the market. Banks are starting to break down on a relative and absolute basis. So instead of looking at the value sector, we'll look at that equal weight, which allows us to de-emphasize some of the really expensive parts of the market, like the tech and communication stocks, which really are the key source of why this market is very expensive. Overall, we still have an overweight to technology just because the momentum, the trends are so very strong. But then we counter that with a slight overweight to energy as a geopolitical and inflation hedge, and then an overweight to healthcare as a defensive play. That's one of the cheaper ways to get defensiveness within this market.
Sounds like you got to be balanced. All right. Well, Cameron Dawson, great to have you. New Edge Advisors Chief Investment Officer. Thanks for taking the time.
Well, mixed news for pharmaceutical companies today, focusing on the weight loss drug race. Let's bring in Anjali Kamlani, who's been following the details. Anjali, one of those names you're tracking, Pfizer, those shares hitting a new low today.
That's right. Really what we got out of Pfizer was expected news, in the sense that their pill for weight loss or type 2 diabetes, in that same category of the drugs, the GLP-1 class, they decided to pick one of their candidates that is a twice daily pill rather than the once daily, which was what investors and those watching the space closely had expected. So because of that, we're seeing that hit to Pfizer's stock. It is one of three that are currently in competition for getting to the market. We know that Novo Nordisk already has its market contender on the market for type 2 approved. Meanwhile, Eli Lilly, specifically with one pill option gearing towards obesity, but other candidates as well and other products as well in the market geared towards type 2. It's really mixed when you talk about that space, just because of the difference between what indications they are already approved for. But suffice it to say that there are three competitors in the space for the pills. We got a note from a JPM analyst talking about how much of a hit this is for Pfizer, noting, quote, "This represents a clear setback to the program in our view, with this specific candidate expected to be the more competitive of the two assets that Pfizer had. They initially had that once daily. So now with this twice daily, they are still working through the phase 2 program for it. Eli Lilly is a little bit ahead with some news out last week on positive indications from its pill. And meanwhile, Pfizer is also going to be working on trying to get this twice daily pill into a once daily format. So, still a lot of stuff in the works. They're still figuring out the dosing and the like. So a lot there to kind of look at.
Yeah, a lot of focus on those two companies moving forward. Anjali Kamlani, thanks so much for that.
The U.S. IPO market making a comeback with 3 large public offerings slated for this week. Here with more on that, Yahoo Finance's Jared Blickery. And Jared, it seems like maybe Cava was enough of a catalyst here for these companies.
I'll tell you what, there were so many eyes on that. And I was there at the New York Stock Exchange that morning. I haven't seen that many people on the floor in years. Lots of eyeballs on that. I'm going to go through these in a second. Let me just show you what Cava has done since then and why that IPO, a lot of people were watching it. Now, here is an intraday chart going back to their IPO date. They IPO'd at $22 a share, and they opened nearly double that. And you can see on the first intra-bar of the day that was down, but there was a consolidation pattern, and the net effect is that they are up from that first day IPO price, and a lot of other IPOs in the past that were bellwethers that sunk, well, you can imagine that would have been a negative sign for the market. But let's get back to what's happening this week, and we're looking for a few of these. There you go. Kodiak Gas Services is one. They're looking to raise up to $352 million in their IPO. Oil and gas services, mainly gas, so interesting to see that coming as we have energy in play today. Savers Value Village, I believe they are the largest thrift store operator in the U.S. At least that's private. $318 million they're looking to raise right now, and I believe the IPO range is right around $20 a share. And then Fidelis Care, their max, they're looking to raise up to $323 million. They do insurance and reinsurance. So bottom line is there's no high-flying tech stories here today, and nothing like I would say Cava, but I think we're going to see a lot of people on the floor and also at the Nasdaq for these listings that we see this week. And I just want to show you where we're coming from. There has been an absolute dearth of IPOs going back to the beginning of last year. This chart goes back to January of 2020, so you can see there was a dearth over the pandemic in the beginning stages, but we really found a stride there in the first quarter of 2021. By the way, that was when GameStop was erupting. So to see all this inactivity and finally get some signs of life, there's a lot of money that wants to come public that are looking for those investors looking for that liquidity event. So here are a number of the mega cap unicorn IPOs that we're still expecting. So we have Instacart. We know what Instacart is. ARM is a chip company. Reddit, of course. Stripe, the financial services company. Panera Bread looking to go public once again. SpaceX didn't even have room for Starlink. That's in there too. Steinway Pianos. So the bottom line is there's a lot that we can expect from the IPO market, assuming the markets stay amenable this year. That's a big if, perhaps.
That is a big if, but a lot of big names there if they do potentially come to market. All right, we're just a few days away from that halfway mark for the year. The Nasdaq is up roughly 30%. We've got the Dow up only 2%. What's the expectation going into the second half of the year?
Well, I was looking at some of the best performing first halves of the year going back to the beginning of the NASDAQ in the early 1970s. We are at number 3 right now. But what happened with the first two biggest dates, and that was 1975 and 1983, we had big down movements for the second half of the year. Now, Bespoke, I was just reading a study by Bespoke that looked at something similar. If you were to filter out those days or those years where you don't have a lot of activity, you don't have a lot of upside activity. In other words, the percentage of up days in the market is not that great. You actually have higher chances of a robust second half of the year. And so that's what they're seeing there. I was also taking a look at the disparity between the NASDAQ and the Dow performance, almost 30% for the NASDAQ versus 2% for the Dow. I'm cooking up some statistics, so I'm going to be writing that up for tomorrow morning. Be sure to check that on yahoofinance.com. But so far, it's not fait accompli that a good first half of the year, especially a gangbuster first half of the year, necessarily leads to second half strength here.
All right, we will wait and see. It'll come soon enough. All right, Jared Blickery, great stuff. Thanks. Well, coming up with all the hype surrounding AI, have big tech companies started to become overpriced? We're going to discuss when we come back.
the priorities of today for the entertainment business were our priorities yesterday, right? Like at the beginning stages, we wanted to be an example of the change that we wanted to see. So our infrastructure is one that's full of color, a landscape of inclusion, right? Because that's what it's supposed to be.
Heartbeat, Kevin's the North Star and sort of the heartbeat of the company. We're working with so many amazing creators across audio, TV, film. And, I think what's really exciting about Heartbeat is it serves as the platform that he's created for the next generation of not just comedic creators, but just creators in general.
The power of culture. And that's a big word, everyone uses it, but we set that as our North Star to really become a cultural icon. We're McDonald's, so we shouldn't just be participating in culture, we should be creating it, which means if you're gonna do it externally, that gives you a thought to how you have to build that culture internally. And that's really what's been the driver of the business for the last 2.5 years.
This is one of the most, if not the most, inclusive brand in the planet. For a portion of population today, particularly Gen Z, ESG, your level of commitment on ESG, it matters. And for others, it's innovation. So the name of the game for us is growth.
The biggest concern, I think, for talent, at least Hollywood talent, would be how long does the writer strike last? How bad is the pullback by the streaming companies in terms of how much they're willing to spend on content? On the other side of the coin, in the music business, where I spend a lot of my time, it's never been better. The live music business is off the charts.
Everybody wants to know, what's the state of that market is. Are things going to come back, storming back? I'd say, look, things are pretty stable. I think that's the sentiment here. People fear a really tough 2023. It's not the fastest growing year ever, but things are pretty stable in the industry. And I think a lot of business is getting done here.
Big tech leaders are gathering this week in Toronto for the 2023 Collision Conference, and it's all about AI. Yahoo Finance's Ali Garfinkel joining us now on the ground at the conference. Ali, what are you hearing?
Hi. How's it going, Shauna? So Collision is one of the biggest tech conferences in the world, and it's become a key meeting place for startups and VCs. Now, it looks relatively quiet behind me right now, but this is a conference that is expected to attract more than 40,000 people over the next few days. And of course, at the center of the conference is AI. So I got here early and I've been talking to VCs about how they're thinking about this AI hype cycle we're in. And shocker, no two VCs have the same opinion. But the one thing everybody does agree on is that it's early days. We talk a lot about AI on the show. We have a lot of excitement. We hear a lot of excitement from analysts, founders, you name it. But most VCs who I've been speaking to are actually sort of in window shopping mode. They're looking at AI companies. A lot of them aren't ready to buy. Now, this actually tracks with the data we're seeing. AI investments in May accounted for about 13% of total VC investments, and we will see that number go up over time. And a lot of VCs I spoke to are actually hoping to connect with some of the companies they're considering here at Collision. And everyone I've spoken to, whether it's on background, on the record, off the record, everyone is taking AI-related meetings. The bottom line here, I would say, Shauna, is that the bulk of AI investments still have yet to happen, and some of them are going to get rolling here at this conference.
Yeah, so some VCs in window shopping mode, you could say, Ali, at least when it comes to AI startups. But the public companies, we have seen huge run-ups in the excitement over AI. Are we starting to see some analysts say, look, things are getting a little overvalued in the space?
It depends on the company is the short answer, Akiko. But the long answer is it's very hard to tell how overpriced an AI company really might be right now. And the best way I can explain this to you is through a metaphor, so bear with me. If you're familiar with the California gold rush metaphor, a lot of folks say that during a gold rush, the best way to make money is to open a hardware store, offer the picks and shovels, don't dig for gold. Well, the gold rush metaphor, even if you've heard it so many times, does fall a little bit short when it comes to AI. When I've been talking to a lot of these VCs, a lot of what they're saying is that a lot of them just don't know quite what the shovels are yet, and we won't know for some time. So I think there are a few questions that folks raised about how substantial the advantage of really being a true first mover in AI is, because we don't know what those picks and shovels are. Especially, I would say, if you're a VC, You can't totally pass either, though. So they're kind of in a sort of catch-22, right? On one hand, you don't want to miss the boat. You want to stay competitive, something that I think a lot of folks who are retail investors, for example, are really excited about and interested in. On the other hand, you've kind of got to walk the line. You've got to make sure you don't get fleeced. And I think everyone's still trying to figure out what that really looks like.
They are, and they're trying to figure out the best investments within that space. Ali Garfinkel, great stuff. Have fun at the conference. Thanks.
Well, we are waiting for some key decisions from the Supreme Court this week. The High Court already, though, adding a controversial case to its docket for later this year. That could throw a wrench into Democrats' plans to tax the wealthy. Rick Newman is here. Rick, this has got a lot of people talking already.
Yeah, it's arcane. I'll try to stay out of the weeds, but it is interesting. So part of the 2017 tax cut, which Republicans passed without any Democrats on board, included a repatriation tax, which didn't affect a lot of people, but basically it said that any Americans who own a certain stake above a threshold in any foreign companies, that they had to pay tax to the U.S. government on that stake as if it were a capital gain. In other words, as if they actually sold their shares in that company, even if they didn't sell the shares. So it would be like if you owned Apple stock here in the United States, you would get taxed on the value of that Apple stock instead of getting taxed on the gain in the stock once you sold it. So there was a couple in Washington state that had to pay almost $15,000 in tax. They protested. They lost on appeal. They lost on a second appeal, and now it's at the Supreme Court. And the reason this matters is this is basically the same principle as a wealth tax that Elizabeth Warren was one of her big proposals when she ran for president in 2020, a wealth tax, so you tax people on their wealth, not on their income, which means on the amount of stuff they hold, not on the amount of stuff they sell. So if the Supreme Court would say, yeah, this is possible, then it opens the door to a wealth tax. And on the other hand, if the Supreme Court says, no, this is not valid, two things. It's going to basically say there is no basis for a wealth tax. And number two, the government's going to have to give back some tax money it collected, and overall it expected to get about $400 billion over 10 years, or something like $40 billion a year. So it matters, but as you pointed out, we're not going to get to this until later this year, and meanwhile, we're probably going to have some momentous decisions coming later this week.
All right, Rick, let's turn to another story that I know you're closely watching, which has real implications for today and really going forward, and that's the latest developments out of Russia following the revolt inside the country over the weekend. Vladimir Putin just holding a televised address moments ago, talking about the fact that they did take all measures to neutralize the danger. He did go on to say that the Wagner troops can join Russian army or go to Belarus. I'm curious just to get your perspective on the events that played out over the weekend and what happens now for Russia and Putin.
The Kremlinology has not been this interesting since the 1991 revolution. This is fascinating. So the small question is what happens to the Wagner mercenary group. And now it sounds like Putin has shifted a little bit from saying this thing is going to be completely disbanded and absorbed by the Russian military to now saying they can have some sort of sanctuary in Belarus, which neighbors Russia to its west and is just north of Ukraine, which is quite a different thing. So that is an interesting development that suggests kind of maybe a second lease on life for Yevgeny Prigozhin, the guy who leads the Wagner group. But the much bigger question is, what kind of fissures are there in Putin's control of Russia? And you just asked a question nobody knows the answer to. What's going to happen next? I guess it's possible that this all settles down. What might be more likely are reprisals throughout the government, perhaps an effort to go after Prigozhin. Maybe he'll fall out of a window, as some Putin critics do, or maybe he'll end up in the hospital with signs of poisoning. Who knows? But most analysts I'm following say this is not over. There's going to be a lot more to come.
Rick, the same question I asked Michael O'Hanlon from Brookings earlier. How does this shift the strategy for the U.S. as well as NATO allies? Could we see them intensify pressure on Vladimir Putin, potentially adding additional sanctions?
Right. You might think, well, this is the most vulnerable Putin has seemed in the 23 years he's been in control. So maybe this is a tipping point, and maybe it's a good time to sort of pile on, which the United States could do with more sanctions. They could lower the price cap on oil, to try to squeeze Russia's oil revenue more. They could certainly give more advanced weapons to Ukraine. But I don't think we're going to see that, at least not anytime soon, because, I mean, I keep hearing people repeat the old Napoleonic phrase, don't interrupt when your enemy is making a mistake. And you don't want to give Putin any reason to say, see, it's what I've been saying all along. The whole West is ganging up on us. NATO is ganging up on us. This is an existential battle for Russia's survival. You want to make it look as if you're staying completely out of it, just business as usual with regard to support for Ukraine. Maybe that will change as time goes, as a little bit of time passes here, so it doesn't look like the United States and Europe have any role at all in whatever challenges Putin faces at home. That's critical. But this sure does seem like it could potentially be the best opportunity for some kind of breakthrough by Ukraine in the whole time this war has been going on. What is it, 16, 17 months at this point?
Yeah, certainly could be additional developments coming here. Rick Newman, as always, thanks so much for that.
Bye, guys.
Well, coming up, TikTok dominating the mobile landscape. But what's next for the social media giant? We've got more on that when Yahoo Finance returns. Crypto prices lower today, but momentum has been strong this year. And now some of the biggest names in finance are making new bets on cryptocurrencies, adding competition and momentum to the space. Yahoo Finance's David Hollerith has more on that story. And David, nothing like a boost of confidence, right, from Wall Street to get investors bullish on crypto again.
Right, Akiko, yeah, the big finance player moves that we've seen in the last 2 weeks obviously started with BlackRock filing an ETF. We also saw EDX markets begin trading, and they're backed by Fidelity, Charles Schwab, and Citadel Securities. And that's a new crypto exchange that doesn't interact with individuals, but kind of serves more like a traditional exchange. And then we have Deutsche Bank also applying to be to custody crypto assets. And outside of BlackRock, a lot of these moves were previously telegraphed as far back as a year. But obviously this came at a really good time, I guess you would say, for the space, just given that a lot of this year so far the story has been regulatory enforcements in the U.S. Leading to lawsuits, and that's still a lot of what we're looking at to determine where things are going. Regulation, of course, in the U.S. is a really big deal, but we've seen obviously the Bitcoin price has surged a lot, and then the total crypto market cap has followed along with that. And we've seen even just higher inflows into Bitcoin associated exchange traded products. So there's a lot of enthusiasm about this. Some of it, most of it actually was previously reported. But I think that it's kind of a reminder that cryptocurrency hasn't gone away as much as it might seem sometimes. When we see earlier this month, in fact, the SEC filing charges against the two largest crypto exchanges in the world.
And David, to that point, at least up until this point, when you take into account the massive run-up that we've seen in the price of Bitcoin, up about 80% year to date, it hasn't yet had a massive impact, but I guess you could make the argument that it's coming off a very depressed level after the implosion of FTX. But what do you think are the key things that investors need to watch for when they're trying to figure out where Bitcoin, where crypto is headed in the second half?
Yeah, always a good question. I think it's fair to think about it this way, which is that regulation has really dominated cryptocurrency asset prices, maybe Bitcoin the least, but still Bitcoin has sagged on bad regulatory news. So regulation is still going to be a major focus. But as things get cleared up, at least I think with the BlackRock and EDX sort of announcements, there's sort of a signal that U.S. businesses or financial institutions, I should say, are still interested in getting involved in the space, and I think that kind of brushes aside some of it. That being said, from what I've heard from crypto hopefuls in Washington, it sounds like there are two bills that are getting ready to be voted on in the House in July. And I've heard sort of optimistically that one of those two bills could be passed in the House by the end of the year. There's a lot less optimism for what could happen in the Senate. And then that being said, the most important lawsuit as far as the ETF goes is the Grayscale lawsuit. Grayscale is suing the SEC for not approving its spot Bitcoin ETF or approving a conversion of its existing product. So the verdict for that case comes out at the beginning of September, and that's going to be really important. And we don't have the exact information. We don't know, but it'd be hard to imagine that the SEC would even consider approving an ETF before that verdict is reached.
Okay, I know you'll be following those developments closely. David Holleran, thank you.
TikTok dominating mobile monetization as it becomes the first app to surpass $1 billion in consumer spending in a single quarter. This according to a recent report by Data.ai. But now the popular video app is looking to expand its online presence with a new in-app shopping feature called Trendy Beat. Now here with more on this and how it could change the online retail game, we want to bring in Sucharita Kadali, Forrester Research retail analyst. Sucharita, it's great to see you again. So we don't have many details just in terms of what exactly this feature is, or I should say how TikTok plans to roll out or even use this feature here in the US. But this is something that many of its competitors in social media have struggled with. Is TikTok, do you think, going to be more successful in this potential e-commerce push?
Well, it sounds like it is going to be something they're going to pilot in the UK first, which has also struggled with TikTok shopping. And it may appear to be something which is a persistent link or tab somewhere, kind of as you navigate through the app. Now, how successful will TikTok be in this endeavor? The truth is, as you said, virtually every social media company has tried its hand at commerce in some way, shape, or form, whether it is players like Facebook in the United States, of course, its subsidiaries like Instagram, other companies like Pinterest, not to mention a slew of players abroad. If anybody has seen any success, it does tend to be Asian companies in Asia. It's very, very difficult to make either European consumers or North American consumers purchase from these social networks. That's just not how we shop, and it may be a little bit of how we discover, but it's not how we buy.
Yeah, it feels like we're already getting some hints of TikTok's strategy. We know they signed a logistics deal a few days ago. That was reported out. We've also heard from Sandy Hawkins, who is the head of U.S. e-commerce, say in the past that she's interested in signing big partnerships with the likes of Walmart to really get the shop service boost again. I mean, are there lessons that can be learned from past failures of other social media apps that will allow TikTok to potentially succeed in this space?
Well, so there are two different things. One is the marketplace partnerships, and there are no shortage of marketplaces out there. Of course, Amazon probably is the big, well, Amazon's definitely the biggest in North America and in much of the world. And there are other marketplaces that are very large globally as well. Virtually all of the companies in Asia, well, several of the large marketplaces in Asia, like JD and the Alibaba family. So as far as the marketplace relationships, they're going to need to have more than just the supply of inventory, because that inventory is everywhere on the internet already. A significant part of the success of any new marketplace does have to do with unique assortment and perhaps some unique brands. And the truth is that the biggest marketplaces have many of those brands already, and the brands that they don't have essentially decided to do direct to consumer and forego the marketplaces, companies like maybe a Nike or a Birkenstock. So I think that will absolutely be a challenge for TikTok. As far as logistics are concerned, that's a whole other just ball of wax that seems like it'll be interesting to know what the specific details are. Shopify tried to get into logistics, and they basically shut that down because it's so difficult to manage. I can understand why they'd want to do it, because you can control more of that shopper experience when you own that logistics last mile. But the truth is, it's really, really hard to get right. And there's a reason that there are a handful of companies around the world that do it. If TikTok really were serious about it, they would probably just ally with Amazon and basically let the new Buy with Prime solution be the TikTok shipping solution.
Yeah, I was going to say, if there's anybody who knows logistics, Amazon's probably the one to tap into. When you look at the landscape, though, on e-commerce, is there a market that is untapped right now? In other words, yes, maybe TikTok can't compete with the likes of Amazon and the vast logistics that they have at their disposal, but is there a lane here for TikTok when you consider just the sheer influence they have, the users, the engagement in place?
One could have said that about Facebook and Instagram and Pinterest Snapchat over the years. And they just haven't been able to monetize the shopping intent. And there's a lot that goes into it. I mean, the truth is that all of those social media companies are advertising platforms, and they've already spent a lot of time and effort optimizing their advertising. When you optimize for commerce, in many ways, it's very different. It requires a lot of really good, strong data feeds. It requires a lot of detail that they may not be equipped to carry about products shots, different, photography from different images, the time that it's going to take to ship the item, the fully loaded cost of that. So they essentially, I think, are at this moment in time pushing all of the transactions to frames so that they don't have to ingest any of that data. They can just pass somebody on to another e-commerce site. But then the question becomes, well, how's that really social commerce? Like, that's no different than what Instagram or Pinterest have been doing for years. So and they haven't been terribly successful at it. I think the hope is that TikTok will maybe drive, because it's so popular, it will yield success with some new generation that has never before purchased in this way. That's a fickle consumer base. These are people that come and go. And, I wouldn't bet that, kind of what social network those shoppers are using today is going to be the same social network they're using anyway, even in 3 to 5 years.
Yeah, certainly competitors have had a very, very tough time at trying to figure out how to be successful at this. We'll see whether or not TikTok is. Well, Sucharita Kodalia, Forrester Research, thanks so much.
Thank you.
Well, coming up, the closing bell on Wall Street. We'll be right back. You're looking at losses across the board with the Dow off just 20 points. And that wraps up today's action on the street, starting the week with losses across the board. Not too far, though, from the flat line, at least for the Dow, closing off just 11 points. S&P off about 0.5%. The Nasdaq leading today's losses. We saw the worst performing sectors among them, technology and communication services. You're looking at the Nasdaq closing off just over 1%. Let's check in on some of the big movers of the day. And we got to talk about Carnival shares closing the day in the red, even after reporting second quarter results that beat the street's expectations. The cruise operator saw a jump in demand, reaching an all-time high for quarterly bookings. Citi leisure and travel analyst James Hardiman telling Yahoo Finance earlier this morning that he believes the negative reaction in shares today could stem from Carnival's strong start to the year. We'll hear from CEO Josh Weinstein later on in this hour. Kiko, but when you take a look at these numbers out from Carnival, an extremely impressive quarter here from the company. Again, a massive jump that we saw in sales, revenue soaring up over 100% from a year ago. Yet the stock was up 80% since the start of the year. So a lot of that maybe optimism already priced in.
Yeah, buy the rumor, sell the news, right? It's essentially what we're looking at. But I'd be curious to talk to Josh Weinstein later about the kind of momentum they're seeing right now, because he did say, look, this is the kind of performance they usually see in Q1 that has extended into Q2, and he's already talked about strong bookings coming through in 2024. So going to be an interesting conversation coming up later in the show. Now, shares of PacWest are closing the day higher after the regional bank announced a $3.5 billion sale of loans to alternative investment manager Ares Management. And you've seen PacWest shares there up more than 4% on the day. The deal, the latest of several moves by the lender to shrink its balance sheet, helped push several other regional banks today. And Shauna, it is about those liquidity concerns at least being eased with this particular move. And you see just all regionals here getting a big lift on the back of that.
Yeah, exactly. And it kind of goes off what we have been saying over the last couple of weeks, some of that optimism returning to the discussion, to the narrative when it comes to regional banks. They are all well off the lows that we saw just about 6 weeks ago with the recent gains. The thought there is saying that the worst is over. There are a lot of questions, though, about the possible headwinds facing some of these regional banks going forward. Lots of talk about tougher capital requirements, what exactly that would mean to some of these smaller banks and their ability here to compete with the larger names out there. But again, a lot's going to come down to what we're hearing from these executives in a second quarter earnings and how exactly, strong their deposit sheets are and what they're looking at in terms of deposit flows. All right, let's take a look at another big mover, and that's Wall Street continuing to rain on Tesla's parade, at least for now. Goldman, the latest bank here to downgrade the company. We're looking at losses of just about 6%. And Tesla, just one of the names out there that has seen analysts really change their tune when it comes to their outlook for these companies. We want to bring Yahoo Finance's Josh Schafer with a closer look at this. And Josh, when it comes to Tesla, some of these other names, questions just about their valuations and if they come too far too fast.
Right, so that's the third downgrade we've seen from a major bank for Tesla in the last week now. We're actually going to have a story rounding that up on the website tomorrow morning, sort of what's going on specifically with Tesla, because it is a little bit of a different story than some of the other tech names. But when you compare it to the other tech names, we are seeing a common theme, and that is sort of a valuation call, right? So you've seen these big run-ups for Tesla, for Apple, for Alphabet to start the year. And then you're seeing moves like this from Goldman where they downgrade the stock from buy to neutral. But you see that price target moving up from $185 up to $248. So a big move up in the price target, but a move down in what they're rating the stock, essentially saying right now that's a fair price for Tesla. Tesla is at right about $248 right now. So what a lot of these analysts are talking about is you have these big AI movements up, right, including in Alphabet and maybe even Apple too, just as that AI momentum has sort of grabbed these stocks. And now they're saying, okay, when we actually assess what AI is worth for this stock right now, maybe we can't quite project that. Interesting, UBS came out and downgraded Alphabet today, saying that AI might be too priced in and they're not quite sure where it's going to go, right? But they upgraded Meta for the same reason, saying people aren't counting AI enough into Meta stock.
Which was a little surprising to me, given this thesis that we've heard from so many analysts up until this point, and even UBS when it comes to Alphabet, the fact that they don't see a lot of that hype already priced into Meta. I almost felt that that was maybe more of a contrarian take.
Yeah, it was interesting because they're talking about Meta's AI model that I don't think a ton of people have talked about yet and really seen when we're talking about an AI chatbot, right? And sort of what that means for Meta in search. And so UBS listed Meta as a major contributor or competitor, I should say, to Google in search with AI, which I think a lot of people have sort of said, well, that's Microsoft and Alphabet's battle to level out, but they're saying Meta's in there. I do think that is probably a different take. It'll be interesting to see if that gets a little bit of pickup as we see what that Meta AI chatbot looks like too.
Certainly will be. All right, Josh Schafer, great stuff. Thanks. Well, lab-cultivated meat could be coming to a restaurant near you. Coming up, we will speak to the Upside Foods COO about chicken that didn't hatch from an egg. We've got the details for you. Stick around. Soon you will be able to eat chicken that didn't hatch from an egg. Lab-grown meat could be coming to a restaurant near you after companies Upside Foods and Good Meat received grants of approval from the USDA to produce and sell their lab-cultivated chicken products in the United States. Joining us now, we want to bring in Amy Chen, Upside Foods COO. Amy, it's great to see you. Before we get into this and what this means for your business going forward, I think a lot of people are asking themselves, what exactly is lab-grown chicken? What is it and how do you make it?
Great. Thanks, Shauna. It's good to be with you today. We call it cultivated chicken. So it's essentially the meat that you have always known, but made in a new way. So it's literally grown from animal cells. So we start with a sample of cells, we feed them nutrients, vitamins, et cetera, in what we call a cultivator. And after anywhere from 1 to 3 weeks, they produce meat that we can then harvest and formulate into any delicious product that you love.
Where do the animal cells come from?
So the animal cells can come from a variety of places. They come from the animal species, so a chicken. In our case, we started with a fertilized egg.
What about cost? Because that has been a huge issue when it comes to lab-grown meat, how costly it is to produce it. What does that look like? How does it stack up against what I guess most people call traditional meat?
Like any new innovation, whether it's electric vehicles or cell phones or anything in that era or in that genre, it will start at a price premium. So we will be launching in select restaurants with limited partners. And over time, we will be continuing to work on both scale and cost. So expect to pay a premium at the outset.
What does that mean in terms of a premium if you compare it to sort of a standard chicken dish? I realize these are going to be in restaurants, premium restaurants, but what kind of price tag are we talking about?
So at a restaurant, think about an organic or a free-range chicken. We'll be in the range of what you would expect to pay for an entree at the restaurants where we launch.
Amy, how much of this can you make? I believe right now you're able to make small volumes of this, but scaling it to make larger volumes. What does the timeline look like for that and the cost of that?
It's a great question. So right now we're operating out of EPIC, which is our engineering, production, and innovation center. Out of that facility, we can produce anywhere from 50,000 pounds in its current configuration up to about 400,000 if we expand. We're simultaneously working on a commercial plant that will be able to produce millions of pounds. So the real vision and the impact is that everything we are doing is working towards scale, because that's what will ultimately allow us to have the impact that we want on the environment, on animal welfare, on human health.
So let's talk about that impact to the environment. I mean, what does the carbon footprint look like for cultivated meat? There's certainly been some criticism about just how energy intensive it can be to grow it in a lab unless you use 100% renewable energy. Is that what Upside Foods is doing?
Our current facility is powered by 100% renewable energy, but let me, Akiko, take a step back. So conventional animal agriculture is responsible for 15% of all greenhouse gases. It's a third of arable land and water, and we slaughter 70 billion plus land animals a year. So the impact and the scale is absolutely staggering. There have been a number of third-party peer-reviewed studies that have said at scale, expect with cultivated meat to reduce that footprint by as much as 90%. So it is a very meaningful impact.
And finally, there's a lot of viewers who are watching this who aren't going to be near these restaurants where the initial tests will be carried out. How long until consumers will be able to find these meats in grocery stores?
I expect it to be a few years before it's grocery stores, although we're running a contest now, so consumers all across the country can actually, until midnight tonight, sign up to be amongst the first to try it in our restaurant launch at Bar Kren. But we'll be debuting in restaurants starting in San Francisco and expanding from there.
Amy, there's a lot to be excited about, but I think many people out there are a little hesitant. They don't know exactly what this is going to taste like. How do you get those people on board? What's your message to those that are saying, hey, I don't think it's going to taste anything like traditional meat?
I will tell you first, I'm a Texan, so I love my meat, I love my barbecue, and it's something that's very precious to me. I will share my own experience. When I first put this bite of cultivated chicken in my mouth, I thought, this is the most amazing, remarkable thing I've ever eaten. It didn't require an animal to be slaughtered. It could literally change the world. And then I chewed and I thought, it tastes just like chicken. And that's exactly what we hope for, that the future tastes as delicious as consumers expect their current meats to be, but in a way and made in a way that people can feel really great about.
Okay, well, I look forward to trying it soon. Amy Chen, Upside Foods COO, it's good to talk to you today. Appreciate the time.
Thank you so much, Kiko. Pleasure.
Well, coming up, could Taylor Swift's Eras Tour become the highest grossing run in concert history? That and more of today's trending stories on the other side. Stick around.
The priorities of today for the entertainment business were our priorities yesterday, right? Like at the beginning stages, we wanted to be an example of the change that we wanted to see. So our infrastructure is one that's full of color, a landscape of inclusion, right? Because that's what it's supposed to be.
Heartbeat, Kevin's the North Star and sort of the heartbeat of the company. We're working with so many amazing creators across audio, TV, film. And, I think what's really exciting about Heartbeat is it serves as the platform that he's created for the next generation of not just comedic creators, but just creators in general.
The power of culture. And that's a big word, everyone uses it, but we set that as our North Star to really become a cultural icon. We're McDonald's, so we shouldn't just be participating in culture, we should be creating it, which means if you're gonna do it externally, that gives you a thought to how you have to build that culture internally. And that's really what's been the driver of the business for the last 2.5 years.
This is one of the most, if not the most, inclusive brand in the planet. For a portion of population today, particularly Gen Z, ESG, your level of commitment on ESG, it matters. And for others, it's innovation. So the name of the game for us is growth.
The biggest concern, I think, for talent, at least Hollywood talent, would be how long does the writer strike last? How bad is the pullback by the streaming companies in terms of how much they're willing to spend on content? On the other side of the coin, in the music business, where I spend a lot of my time, it's never been better. The live music business is off the charts.
Everybody wants to know, what's the state of that market is. Are things going to come back, storming back? I'd say, look, things are pretty stable. I think that's the sentiment here. People fear a really tough 2023. It's not the fastest growing year ever, but things are pretty stable in the industry. And I think a lot of business is getting done here.
Welcome back to Yahoo Finance Live. I'm Alexandra Cannell, joined here by Josh Schafer and Prasi Mermanian. We're once again chatting the top stories of the day, kicking things off with Meta, the company announcing it's going to be introducing a virtual reality subscription service dubbed Meta Quest Plus. It seems like every streaming service or a subscription service, something with a plus at the end of it. But this is going to give users access to 2 new games each month at a cost of $7.99 per month. And personally, guys, I think this is a pretty smart idea for Meta, since it's going to be allowing them to generate reoccurring revenue for their AR VR unit, which reported a loss of about $4 billion in the first quarter. So they need this money. And I think from the consumer standpoint, if you purchase one of these headsets, you're going to want to subscribe to have the new games, right? And they're going to release new games on the first of each new month. So I think it's a win-win here.
It's not an unheard of thing for video game platforms, right? If you're a true gamer, you've been paying some kind of subscription service for years now, really, when you think about like an Xbox Live, PlayStation Live, when they first started doing those over a decade ago, 15 years ago. People have been paying money for that kind of service. So I think from that perspective, it will do fine with consumers. And then, I mean, when you look at it from Meta's perspective, not only is it a good idea, you wonder if it has to work. Like, does this have to work for the Quest and overall for this entire metaverse concept to be successful? Like, do you need subscriptions to be a part of it? You almost feel like you do, right? If you're only selling the headset for, what is it, $300-400, you're gonna need some kind of recurring revenue there. You're not just buying an iPhone, you're paying for services on the iPhone, right? That's the key to Apple's real business.
Yeah, and I think it gives you this load in of a bunch of games right off the bat that you can actually use right when you buy this $300 or $400 Quest, whatever they're calling it. Yeah, it's funny because I'm an Xbox Live member, been so for a while. Recently, they've really amped up the huge amount of games. Like, you want a whole catalog, whole library. 2 a month to me is kind of like, I could use a bit more for really hardcore people might want to just kind of plow through games.
New platform though too. You wonder how many games they have and how many games are backloaded, right?
Yeah, but Quest has been out for a while. They should have more. I think
or if they're going to tier it, maybe they're testing this, and then if you want access to more games, you have to pay more than the $7.99 a month. That could be an option too.
Yeah, maybe. But also for Meta and Facebook, like you mentioned, subscription revenue. You need that. It's great. This is the future of gaming. It all sort of makes sense, I think, from a user and a company point of view.
I think just when you zoom out too, interesting to see a social media company wanting to go that subscription route, right? We were talking about that last week with ads and media companies and how it's not that great of an ad environment. Makes you wonder about Instagram subscriptions, Facebook subscriptions, just as you build that out and think about the business, if you become more of a subscription-based business.
If I need to pay money to use Instagram.
Oh, my Facebook's gone. My Facebook's gone.
It's
Instagram's
over.
probably gone.
I would pay $10 a month for Instagram.
$10 a month?
Yeah, hell yeah, every day.
It would hurt my soul, but I wonder if you're pressured to do it and if everyone was doing it, if you would.
I just got to say that $2 billion loss last quarter, not last year, last quarter. I mean, for Reality Labs, that's insane.
Yeah.
All right, Pras, you'd pay $10 a month for Instagram.
Yeah.
How much would you pay for a Taylor Swift concert ticket? Another story we're watching today. They're saying she might get over $1 billion on this concert tour that she's on right now, the Eras Tour. Yeah. That's the Wall Street Journal coming out today with that projection. Essentially, the projection coming from a former $590 million projection when she had, I think it was about 52, 56 shows. Now you double that to over 100 shows. That extrapolates that to, 106 shows right there. That extrapolates that number to over potentially $1 billion in revenue. Obviously an eye-popping number. I'm wondering if it's sustainable, what it compares to. I think it would be the biggest concert ever, right? It would be the biggest tour ever.
I mean, if anyone's going to do it, it's Taylor Swift, right? But what we were talking about, is it sustainable? Can you recreate this $1 billion concert tour? I'm not sure if you can, because it was sort of the perfect storm for Taylor Swift. She canceled her Lovers tour due to COVID. Then she announced a whole Eras tour. So if you're a big Swiftie and you're going to go to this concert and pay for one concert but have her sing these songs over the past few decade or so. I mean, that is really a lucrative value proposition for a lot of these consumers, and I think they were willing to pay up a bit. But I do wonder if that's a sustainable model moving forward. But against all of that is a backdrop that we have live events booming, live concerts booming. You were just at a live concert.
I was at a live concert on Friday night. Zach Bryan in New York. It's very crowded, but I did not pay $5,000 for the ticket, so I don't know how often.
Good performer.
Great performer.
I'm not a huge Swift fan, but I do not deny the unstoppable nature of her fans and her just empire. I mean, 100 shows, $1 billion, that's $10 million a show, right? That's my loose math there. I mean, this is a massive operation. I think something like 90 semi-trucks are needed for to go from city to city for all her tour equipment. I mean, it's a massive operation, deeply impressive. But I'm like, how do you sort of bet on that, right? Is it Live Nation? Can I get a Swift ETF? Like, what? How do I make money off
it? It would be Live Nation if they didn't have all the problems with the tickets, though, right? That's been part of the story, I think,
But is that the only broker for her? Like, is that how?
I think it was the main broker, right? Ali, you covered that story.
Yeah. Ticketmaster, Live Nation is a parent company of Ticketmaster. That was obviously a huge issue when those tickets came out. But you're looking at your screen now. This was super interesting to me. Yeah. The top 3 highest grossing tours of all time. But look at the number of shows, right? If Taylor Swift is able to hit 1 billion with just 106 shows, Elton John played 293 shows to just get above 850 million. Ed Sheeran, the same, 258. U2, 110 shows. I also thought it was interesting that all of these artists are not from America, right? So Taylor Swift would be the first US-based American artist to kind of reach the top there.
I think it's interesting, too, when you think about Taylor and how I would argue her demographic of fans is wider than the 3 people we just showed to. It seems like everyone goes to a Taylor Swift concert, and while I like some of Elton John's music, I'm not sure how much I'm paying to go to that concert as a younger person. But, I like Elton John's music. I would maybe go to the concert, but I think Taylor Swift has more of a catch-all, I guess, when it comes to fans.
The fact that Yahoo Finance says Jared Blickery and Miles Udlin were at the Taylor Swift concert just illustrates that point. And if you know who they are, you'll understand why. That's a shocker to me.
I was surprised, those guys over there, Elton John, right? Who's the other one? I'm not sure, but the other one. Oh, U2. Older acts, with huge bases of fans, right? You think of Billy Joel, people like that, right?
But that was U2 and U2's prime, too. Right. You should know. That was the 2000, 2002 album. But they were pretty big then.
I guess what I'm saying is Swift is young. She can tour forever. I mean, she could do a 500 show tour, and it's going to make how many billions of dollars? I mean, it's absolutely insane. Yeah, it's absolutely insane. It's a juggernaut. How do you stop it? I mean, $10 million a show. I'm just amazed by that take. It's just mind-blowing to me.
I don't think it has staying power, though. I still argue that. I just don't see how you come back to MetLife again next year, 3 straight nights, and you get people to buy $5,000 tickets on the secondary market.
I disagree with
that.
You
That doesn't.
People went every single night in a row when she was at.
You think you can just repeat that year over year at every venue?
For Taylor, maybe.
Maybe. I mean, we'll find out. We'll have the same discussion next year and we'll see. But I just don't see how you consistently do. Even the Super Bowl has ebbs and flows of prices, right? It depends on what's going on. Yeah, I don't know. Sometimes it just doesn't work out the same.
I mean, who's the next Swift? That's the big question I want to ask. But anyway, sticking with the world of entertainment, Ryan Reynolds, right? I mean, this guy is unstoppable, I think, on and off the screen. He's partnering with Redbird Capital and his partner Rob McElhenney from Wrexham. They're buying a stake in the Alpine F1 team. It's a French team backed by Renault for about $220 million. I mean, that's a lot of money. This is valuing the F1 team at $1 billion. I mean, it's a big deal. But I gotta say, it's a win-win for both sides here. Yeah. You get Ryan Reynolds and his team get into F1. It's huge in this country, getting bigger worldwide. And then you have Alpine, who's kind of a no-name team, and they get the Ryan Reynolds effect. Right.
Boost Mobile effect.
Yeah, right.
It's why you had Ryan Reynolds partner with Boost Mobile, a company like that, right? It's why these sports teams like when former athletes buy in or former celebrities buy in. It puts way more attention to what you're doing. Ryan Reynolds also bought that Wrexham team. It was a soccer team over in Europe, and they did a Hulu show on it. So be curious how that might interact with this too. Do you build out a show? We know Netflix Drive to Survive has been so popular. Is Ryan Reynolds now going to be on Netflix Drive to Survive?
I was just going to ask, why do you think F1 in particular, out of all the sports teams?
If I were buying a sports team right now, it's something like F1 makes sense. People say the NHL makes sense and Major League Soccer makes sense just because valuations are lower, right? It's like trying to buy into companies we talk about now. If you're buying into like an Apple or a Tesla, it's a lot more expensive than if you're buying into F1.
Yeah,
F1 it's big, but it has not taken off to the point where one of these teams is worth $6 billion like the Commanders just sold.
I mean, 10 years ago, an F1 team, give or take, worth around $200 million, right? The Netflix effect 5 years ago, all that sort of stuff, the pandemic effect, people watching more sports, now $1 billion for a small French team. I mean, it's kind of insane, but I totally get it. And I see why you'd want to get, like you said, ground floor MLS, ground floor F1, these sports that are sort of on the peak or nearing their peak, not there yet, but maybe, obviously F1 is China exposure.
I was just going to say, to me too, it's also the worldwide part of it, right?
Yeah.
F1 is a lot
They
more
want to go in
global
Africa. They want to go in Africa
than
now.
US
So
leagues.
It'll
be interesting to see how much that drives that revenue going forward, I think, too.
Yeah.
Yeah, and just interesting to see celebrities really leaning in on different types of investments, broadening their business reach.
Once you have a certain amount of money, you just got to find different places to put it, I think.
If it was just Redbird Capital, we would not be talking about the story at all, right?
Exactly.
No one cares. I mean, they own parts of the Red Sox and the Penguins and also Liverpool. I'm sorry, AC Milan. AC Milan, yeah. So it's like they're a big company, but no one cares without. Also Michael B. Jordan, also part of this, so it's kind of a big deal.
Love me some Michael B. Jordan. Well, we're going to keep racing towards the end of this show here, no pun intended. We'll be right back with Yahoo Finance Live, including a deeper dive on Carnival, coming up next. All eyes are on the Supreme Court this week as we get decisions on a number of important cases. Millions of Americans are waiting to see what the court will do with President Biden's student loan program, which aims to erase up to $20,000 in loans per borrower. Now, the cost of college has more than doubled in the 21st century, taking into consideration student loan interest.
and loss of income, the total cost of a bachelor's degree may exceed $500,000. That's at least according to the Education Data Initiative. So, as an investor, how should you start to think about saving up for the expense? Here with some tips is content creator Ross Mack, Macconomics financial expert. Ross, this is really kind of the final piece when you think about the uncertainty around student loan repayments. The president has even expressed pessimism that the court will rule in his favor. What do you think is going to be the most immediate impact if, in fact, student loan forgiveness is where Supreme Court rules against student loan forgiveness?
Well, one, I always try to err on the side of caution where I only say I can only control what I can control. In the event that the Supreme Court actually does rule in his favor, then I think consumers are going to be a lot more healthier, right? I think from a consumer sentiment standpoint, people will obviously have a lot more money in terms of earnings that they'll be able to maintain as opposed to actually paying out student loans.
Ross, for those out there who do have some extra money, maybe they aren't faced with student loans, maybe they're trying to figure out the best ways to position themselves going forward. And I know one of your big focuses is building generational wealth. If you're looking to be in a position where your kids maybe hopefully won't need to take on student loans, a couple of different ways to save there. The first idea that you have is a 529. How does it work? Why does it make sense?
I love that question. The thing is, I try to tell people, let's try to focus on giving our kids the experiences that we didn't have as opposed to the frugal things we didn't have, right? So in other words, let's teach them what we didn't know as opposed to trying to give them the new Jordans, right? So for me, it's like, why not give our children the ability to, one, learn about investing, but two, also have the ability and the freedom to graduate college without any student loans. And like you said, in the next 18 years or so, we're talking about over $500,000 for when my kids getting ready to go to college. So the way I'm thinking about it is, let's start putting money aside today and being very intentional. So a 529, I want you to look at that as a tax advantage college savings plans where you can literally start putting money aside today and that will grow effectively tax-free. So as long as you're using that money for qualified educational expenses, whether that's obviously tuition, room and board, books, and what have you.
18-year timeline is a very long one, Ross. There's a lot of parents looking at this saying, well, when do I start putting that money aside? What do you say?
So I would say the sooner the better, right? And when you really are thinking about this, you have one thing on your side, and that is compound interest, right? And the words of the great Einstein, he who understands compound interest earns it, and he who doesn't pays it. And so compound interest is the ability for your money to start making interest, and that interest is thus being reinvested. And so the sooner rather than later. So for me, I have several accounts for my children, one being a 529, where I'm starting to take money out every check, every month, right? It's all about being consistent, as well as a custodial account. I think a custodial account is another great thing that is a great learning opportunity for your children because, one, you get to actually teach them how to become owners of some of their greatest businesses that they actually use, right? My daughter's on YouTube every day. She wants to watch Miss Rachel. Well, guess what? I want you to also own the owner of YouTube, right? Let's own Google, right? Let's own, as obviously she'll get older, she'll want to own whether it's Meta or Chipotle or McDonald's. And so I think having an actual custodial account, it's important to, one, start allowing them to start learning about the way the world works, but also allowing them to become owners.
Ross, you mentioned Miss Rachel. We're big fans of Miss Rachel inside our house as well. But people are trying to figure out how much money to set aside or to allocate to each of these types of accounts. I guess when you're trying to figure out how much to put in a 529 versus a custodial account, how should people be thinking about that?
I love that question. So one, when it comes to figuring out how much, obviously you can work backwards. There are several, almost call it investment aggregators online to say, okay, in 20 years, I want to have $200,000. How much? And you say what your, expected rate of return would be. On average, if we're talking about the S&P 500, that's going to be 10%. So if you say on average, this is what I want to do, and you can obviously work backwards. I say at a minimum, right? You want to start, I won't say a minimum because everybody's going to be in a different financial standpoint, but I think the goal is to start, say $50 or $100 a month. And as you begin to make more money, so, you will also be able to amp up and say, okay, I want to raise it from 100 to 150 or 200, et cetera. And I think that is really how you do it. But it all starts with the budget, right? I think once we understand and figure out better ways to understand what our outflows are, we'll be able to purely say, okay, let's make saving and investing a priority. Let's also make that a bill. And so now not only do we have, our mortgage, our car notes and, insurance bills, et cetera, things that we got to pay on a monthly, but let's also pay our 529 account. Let's pay our custodial accounts. Let's pay our own personal retirement accounts. So I look at it as saying, let's make it all a bill, but you start off, maybe $50 or $100. And as you continue to make more money, maybe you start increasing that allocation size.
Ross, I'm curious about that investment conversation you have with your kids, because I've heard this discussion in so many households where, for example, parents say, look, you pick the name that you like so kids can understand better what that investment thesis is. How do you open up that conversation? I'm just curious how you've had it with your kids.
Well, I think we all are tied to the things that we utilize on a day-to-day, right? And so right now, if I have an Apple phone, if I have an iPhone, if I'm on a Mac, on an iMac, or if I have AirPods, it's great to start having the conversation with my kids that, hey, listen, Apple owns this. If we're eating and driving past McDonald's all the time, it's great to let them know, okay, you can actually own this company. And so for me, the conversation, and obviously, if you see my content, my kids are 2 and 1, so it's pretty early, but I love having a conversation anyway, because when we start talking about certain shows that my daughter watches on Disney, well, guess what? You own Disney. And so I think what's very important is to understand, look, guys, as the world, we are all consumers of something, whether it's a service or actual business, but nonetheless, there's an ability, right, if it's a public company, to also be an owner. And that way, if your friends, right, if your kids' friends are going to McDonald's or Chipotle or wearing Nike, guess what? You could actually own that. And now as your child looks and say that they're owners, they're also looking at their friends and saying, thank you. Thanks for shopping with me now.
Ross Mack, appreciate your takeaways here as always. Thank you so much for joining us today.
Thank you so much. If I could say one thing, I'm having a Maconomics Wealth Summit here in Chicago on July 9th. And it's all about this conversation, right? It's for the community to actually help individuals understand how to better, attack wealth, right? I think we have to have these conversations early on. We have some amazing people coming out. We'll be talking about life insurance, retirement planning, also how to ensure your kids can graduate without any student loans. And so July 9th, Maconomics Wealth Summit here in Chicago is going to be amazing.
Got to get that plug in. Ross, thanks so much for that.
Thank you.
Americans are saving for retirement at record rates. According to a recent report from Vanguard, 39% of workers increased the percentage of their paycheck that they set aside for their 401k account last year. Yahoo Finance's Carrie Hennon is following this story for us. Carrie, finally, some good news on the retirement front in terms of how much people are saving.
I know. I absolutely love it. I mean, they're looking back at last year, and it was a pretty rough year, wasn't it? I mean, the market volatility, we did see account balances droop. But you know what? The savers, investors in these 401k plans that Vanguard manages stayed the course. And in fact, the great news is they upped the ante. They 8 and 10 are now enrolled in their plan, and that has just gradually been increasing since 2013, which is great news. And as you mentioned, 4 and 10 increased how much they set aside. I mean, it is really, according to Vanguard, these are record highs of the percentage of your paycheck people are putting aside in these retirement accounts. And that's super positive. And I think that when you combine it, I think the average is like 7.4%. When you combine it, what the employer match is, and this is the cool thing, 2/3, I think they said 2/3 of their fund companies have 2/3 of the participants are putting enough away to get that match. That is awesome because that is free money, right? That is just a great perk. And so when you put that together, it's like 11.3%. And most financial planners suggest that you set aside anywhere from 12 to 15% of your income for retirement. So people are getting super close. This is very positive in what went on last year. And what I also think is important is, let's say, okay, my gosh, Carrie, why is this happening? Well, the number one reason is auto enrollment. More and more plans and employers are automatically putting people in the 401k plan without, as soon as they come on board. And so you don't have to opt into it. You have to opt out of it. And they found that, more people, 93% of people that are automatically enrolled are participating in their retirement plan versus only 70% when you have to make that choice whether to sign up for your retirement plan. You think, oh my gosh, I can't possibly set enough money aside. So this is a very key thing. And the other piece of that is auto escalation. So why we're seeing those increased numbers in the savings is because employers are tacking in this thing that each year they bump you up 1% unless you opt out of it. And often we do decide ourselves to put more aside for our retirement, but at least that little bit more each year really helps you meet your goal.
So, Carrie, you've walked us through the positives of the report. What are some things you found that concerned you?
Yeah, this is the piece that we have to okay, this is good news. People are saving. But there were more people, Vanguard found more people did take hardship loans from their 401ks. And this is not a loan. This is, this is a hardship withdrawal. So it's not a loan. You're actually taking the money out. Some people did take loans, that's true, and you do have a repayment schedule. But when you withdraw, that went up last year, and that's we can understand why with the inflationary numbers and so forth. And the two main reasons were for housing issues, people facing foreclosure and eviction, and also medical expenses. And so what's concerning to me about that is that when you do withdraw money, you not only pay tax on that money you took out, but you're also paying a 10% penalty if you're younger than 59 and a half. So again, that is a little troubling and indicative of some people were still actually, really facing some headwinds last year.
Got to take the good with the bad. Carrie Hannon, as always, thank you.
Thank you.
Carnival shares sliding on the day despite better than expected earnings results and upbeat guidance as travel companies benefit from pent-up demand. Joining us now is Carnival CEO, President, and Chief Climate Officer Josh Weinstein. Josh, it's great to see you. Thanks so much for being here. So a very strong quarter, revenue doubling from a year ago, customer deposits hitting a record. You raised your outlook, yet the stock sinking today. And I think a lot of investors out there are questioning how much more room there is to run. What's your message to them?
Oh, my message is we've just scratched the surface. So first, thank you for having me. I can tell you that we ended our second quarter, as you said, in a pretty strong way. We set records. I mean, the one word I could use to describe it is record. It was record yields, record revenue for the second quarter, record customer deposit levels. And here's the future stat for you. So typically in our industry, we have a wave period of bookings, and the wave period, which is our peak booking period, is the first quarter of the year. What happened with us? Well, what happened with us is we started our wave period in the fourth quarter with a Black Friday event that just literally started with a bang. Our first quarter, the traditional wave period, did set a record. And that was great until the second quarter, where we beat the first quarter. And that is truly unprecedented. And in the first 3 weeks of June of our third quarter, it hasn't slowed down. And so the fact is that demand is real. And I would actually say at this point, I don't look at it for our business, for our brands of world-class brands, a portfolio of world-class brands, as real pent-up demand because they hadn't been able to cruise at this point. This is just demand. This is just people wanting experiences, looking for great value, looking for great brands, and they're finding us.
Josh, let's talk about per diems, up 7.5% in the quarter. You're now forecasting growth of 5.5% to 6.5% above the 2019 levels for this year. How much higher can that go?
So our expectation is, we set some targets for ourselves, 3-year targets that'll get us out to 2026. And we expect a good amount of run up in yield. Now, clearly, we've still got some occupancy to make up when you think about our annualized occupancy levels. And so we'd expect to get back to full historical levels next year, which is going to be a nice jump in revenue. But on the per diem side, on top of that, we expect low to mid single digit per diem increases over the next several years. And we think we can achieve that.
Josh, there's lots of focus on getting back to profitability. Your balance sheet, yes, does look a lot better to where you were when you compare to those peak debt levels here. But what's your largest obstacle, your biggest challenge when you're trying to get back, when you're trying to get to profitability?
From our profitability for the third quarter, we'll be profitable in the third quarter. And that's a turning point for us, just like hitting positive yields was a turning point in this second quarter. And we're looking forward to 2024 and beyond, where profitability is not going to be the question mark hanging over the industry. We are showing incredible progress every single quarter. We are just making leaps and bounds. I think, for us, it's a long-term game, and we want to see that progress every single quarter, and that's what we're delivering, and that's what we expect to keep delivering every quarter. And that's the mandate internally, and that's what we're focused on.
Josh, whenever we talk about cruises, we tend to bring up the demographics, right? We know who the loyal customers are. Some would call them boomers, but you've obviously got a number of brands out there that are trying to bring a newer, younger demographic into the fold. How do you do that? And what specifically, or how specifically are you targeting them?
So because we have a portfolio, we've got brands that are really catering to different segments, different demographics. We've got Carnival Cruise Line. It is America's cruise line. It caters to younger people, to folks in their 20s who are single looking to go for a quick holiday with their friends, to families with young kids looking for a cost-effective way to have an amazing family experience. And so we've got brands that can really do that. Now, our focus, we have truly, despite the strength of our brands, despite being number 1 or 2 in every single major cruise market in the world, we have not done a good enough job of getting even higher awareness and consideration of our brands, because we simply haven't been spending nearly enough in advertising, which has been a change of approach since I joined about 9 months ago in this role. And you can see that paying off. And I'll give you a great example. In the first quarter of this year to the second quarter of this year, the number of repeat cruisers that our brands carried stayed the same. It was great. It's a solid level, and it stayed the same. We went up in total number of passengers carried by about 13%. That entire growth in passengers was from new to brand and new to cruise. So our message is getting out there, and it's really starting to resonate with, as you said, a broad audience, indeed.
Josh, demand certainly has been strong, but what about risk of recession? If we do see one, what's the impact?
We're in a very good position when it comes to thinking about what's the impact of a recession on our business. At any one time, we're about 50% booked for the entire year. And now we're getting better and better at getting people to spend their onboard experiences beforehand too. So even that, we're getting more visibility and getting it quicker. On top of that, I hate to say this, but I do say it. We are an outrageous value to land, anywhere from 25 to 50% less expensive to come on one of our ships than a comparable vacation, whether it's a theme park, a city break, whatever it might be. That is outrageous. Now, the good news for us is in a time of a recession, that value gap shines through. And as people are thinking about how do I spend my hard-earned money to make my vacation work, because that's one of the last things that they're going to give up. And that's where the value proposition really shines. We've got a strategy with our leading brands around the world. We've got about 75% of our capacity of our ships. They are positioned where our source markets are, where our Americans are for our North American brands, Germany, the United Kingdom, et cetera. By being able to do that, we take a lot of cost out of the equation when people are thinking about their holiday with us versus alternatives.
Mm-hmm. Well, your momentum certainly being reflected in the numbers. Josh Weinstein, Carnival CEO, President, and Chief Climate Officer. Good to talk to you today.
Thank you very much for having me.
Well, after the break, we're going to get you up to speed with today's top stories. Stick around.
prior to the weekend events, the Kremlin and Wagner Group worked collaboratively. The fact that the coup did not work, it's not entirely clear if Wagner will come back and fight with Russia. And then once you have something like this happen, people are questioning the staying power of Putin. So until people can be certain that Putin is the man in charge and is the person that they can talk to, the idea of a negotiated settlement with Russia is now just off the table.
I didn't see it coming. I have no idea what it means. What I do know is companies and lenders will not lend money to lose money. And with all the yield curves inverted, that ultimately should have some kind of impact on economic growth and therefore the markets.
Is Vladimir Putin's leadership falling apart? Just a mind-blowing series of developments in Russia, and many analysts think it's not close to being over yet.
I think the really interesting news that's really catching traders' attention is what's happening in Russia, and that's with the potential coup on Vladimir Putin. Now, I'm taking a look at the Wi-Fi Interactive. The price action since the open yesterday and Sunday evening, really not that volatile.
I was able to reach out to Andy Lippo of Lippo Oil Associates. If this does lead to a civil war, if this is the beginning of the end for Vladimir Putin, you could see a disruption when it comes to the oil coming out of Russia. Although there is a contrarian view, which is that if Vladimir Putin continues with his strategy, you could see more supply of oil coming into the market, and this would be bearish for the oil markets.
China's leader made a major mistake of his unlimited friendship with Mr. Putin. And what's that doing? Overall, to me, it's tilting the whole world towards recession. China's having a problem, and all the data is disappointing. That's the body in motion. You have to ask yourself what stops it. So I see crude oil is more likely to head towards 50, maybe even 40, based on what's already happened.
It is closing time here at Yahoo Finance Live. Here's a look at some of the top stories of the day. Russian President Vladimir Putin breaking his silence after the mercenary rebellion over the weekend. Putin warning in a televised address to the nation that those involved in that revolt will be, in his words, brought to justice. He said the Wagner soldiers have the opportunity to sign contracts with Russia's military or go to Belarus. This coming just hours after the head of the Wagner mercenary group, Yevgeny Prigozhin, defended his actions. He denied trying to oust Putin from power.
Carnival shares is sliding more than 7% on the day, despite second quarter results beating estimates. But the stock has been on fire this year as demand rebounded. Ahead of today's move, shares were up 96%. Carnival CEO telling us moments ago that the cruise line is just, quote, scratching the surface on demand and will be profitable in the third quarter.
And finally, Tesla suffering another downgrade. Goldman Sachs cutting the stock to neutral from buy. This comes after similar moves from Barclays and Morgan Stanley. Despite the downgrade, the Goldman analyst did raise its price target to $248 a share.
All right, well, that does it for us today on Yahoo Finance Live. We'll see you right back here again tomorrow afternoon. Have a good night.